Welcome to this Bennett Explains finance video. This week, the first rule of stock market investing and, more importantly, how to make it work for you. So what I'm claiming is the first rule of stock market investing? Well, let's look no further than the man known as the Sage of Omaha, Warren Buffett. Now, he is a chap worth looking to, hugely successful American investor. Basically, he's the chairman of Berkshire Hathaway, and over the course of an investing lifetime that's taken him well into his 80s, his net worth has amassed up to 63 billion US dollars. So here's somebody who started from scratch and made a huge amount of money from successful long-term investing. And his rule, slightly tongue-in-cheek you might say, but very valid, his rule about stock market investing is, number one, don't lose money. And then being a bit of a comedian, he said rule number two is don't forget about rule number one. Fine, but the big question, which must be lurking out there, is how exactly do I do that? Now, in a nutshell, it's quite simple to say, less easy to do. In a nutshell, successful equity investing, something I've said before, is all about time in the market rather than trying to time the market. In a moment, I'm going to put up a chart that shows pretty clearly as it possibly could, why that is, and answers the question, or tries to, using the past, well, how long do I need to spend time in the market to make this work for me? Now, the past is no guarantee of the future, but the chart coming up is pretty powerful. Now, don't take it from me, all right? This thing about not trying to time the market doesn't have to be just, Tim Bennett's word you listen to. Warren Buffett, there he is again, said we continue to make more money when snoring than active. In other words, leaving your money to grow, compound over the long term, something I deal with in other videos, is vital. But he's backed up by a whole load of other people. So, for example, Peter Lynch, very famous investor and author, said, I can't recall ever once having seen the name of a market timer on the Forbes annual rich list. All right? In other words, the people who make money in the stock market tend to do it over long periods of time and tend to have a consistent investment strategy along the way. And the third quote, there are plenty I could have called on, but Bernard Baruch once said, only liars manage to always be out during the bad times and in during the good times. In other words, market timing sounds like a fabulous thing to do. You get out when the market's falling, you get back in again when it's rising. But for most mortals, it's actually pretty difficult to do. And people who claim to have done it have usually got pretty lucky somewhere along the line in the process. And let's say you do get out of the market, that leaves you with a difficult question of when to get back in again. So it's kind of a two-edged problem, if you like. So, plenty more quotes I could have put up there, but there are three big heavyweight investors who are not big fans of market timing and are fans of time in the market. Now, let's get to the question. I'm going to cut straight to the chase. Here's a slide you'll have seen before if you watch my videos regularly, showing the FTSE All-Share total return, that's dividends included, from way back the start of the 1970s, a really bad period for shares, right up to near enough the current day. And this is one you'll have seen before. So the point I want to make is just this, that to get from, let's say, an initial investment back here of just £6,000 up to, say, £650,000 when this was cut off, all right, you'd need to have weathered quite a long period, potentially, during which there were some quite substantial dips along the way. And this one here doesn't look very big, but that was enormous. Stock market lost 2/3 of its value back in the early 1970s. But the question people will be thinking about is, well, how long do you need to stay invested to make the most of these stock market returns? Now, I stress, the past is no guaranteed guide to the future, but the next chart is pretty interesting and pretty powerful. One of the most powerful charts I've seen recently, and here it is. It's drawn from the Barclays Equity Gilt Study, very authoritative report, and it's the latest one I could get hold of, 2015. Now you might be thinking, what on earth is this thing trying to show? Well, what it's doing is this. This is maximum and minimum real returns, that's inflation-adjusted returns, and I've indicated there how that's been done by Barclays using a cost of living index based on inflation, and then when it was available, retail price index data from the government, the Office for National Statistics. So these are real inflation-adjusted returns over various different periods, and you've got them here since going way back to 1899, and they've done this across three asset classes. You've got them there Cash is the light blue box. Gilts, government IOUs, are the kind of slightly darker blue box. And equities, the very heavy box. Now, what is this trying to show? Well, it's actually quite interesting. You've got in a percentage, real returns at the bottom. Negative, don't forget, because if you only make, say, a 1% return on equities in a given year where inflation is 5%, you've lost 4. Your kind of gross or nominal return of 1 minus your inflation takes you down to your real return. So it's possible for your real return, inflation adjusted, to be negative, whether you're looking at cash, whether you're looking at gilts, whether you're looking at equities, or hopefully you want to be sort of up this end where you're making, positive returns, if you like. Now, how do you interpret this? What it's saying is, if you were to pick any 1 year period since 1899, so you just invest for 1 year in that period from 1899 up to 2015, this is probably what you expect to happen right here. The variance of your returns from equities are huge. This bar here is saying that, frankly, it's lucky dip in the equity market. You could lose a lot of money, you could make a lot of money. Frankly, your maximum and minimum returns all over the place. All right, with gilts, you see that bar just there, government IOUs, your 1 year return in any year during that period, still pretty variable. And with cash, a little bit less variable. And that's kind of what you'd expect, because the return from cash is more predictable over a 1 year period, you could argue, than it is for government IOUs, and both of those are more predictable than shares. But look what happens as you extend the period you hold each of these assets. So what you're seeing is, as you move the holding period up from a year to 5 years, these bars narrow. So in other words, the likely range of outcomes, maximum, minimum, real inflation adjusted returns, starts to narrow for all 3 asset classes. And as you move to 10, it gets narrower. And look what's happening up here as you move to 20 years. Now this is any 20-year period since 1899, not a specific 20-year period, and then any 23-year period since 1899. And the one that's really interesting is the one right at the top, because if you can see it, if you look at what's happened to these bars here, this is picking any 23-year period since 1899. On average, not only is your minimum return on a real basis from equities positive, it's just, if you can see that on the right-hand side of that 0, but both the maximum and, more surprisingly, the minimum return from shares beats the expected average return from both government IOUs and also cash. And what were the chances of that happening? But before you rush out and say, great, the key to this is time in the market, because you are looking from this data at 23-year holding periods. But according to Barclays, were you to pick any 23-year holding period between 1899 and 2015, you could be in a situation where both your minimum and maximum returns from the stock market beat, on average, gilts and cash. And that's pretty powerful. And understandably, as you reduce that holding period, well, your return from each asset class, what you might expect to get out, gets more unpredictable, and the odds that you make a bigger loss from equities increases. But you can see from this that the length of time you spend invested in the equity market as you move up significantly impacts your likely outcome and how happy you're likely to be. That's the chart that I wanted to get to in this week's presentation. So I'll leave you with that thought. And if you've got any questions on what I've just said, please do email me at the usual place.